For more on the Fed, let's bring in Jim Grant, founder and editor of Grant's Interest Rate Observer. Jim, great to have you on. Given the fact that we are talking about inflation, we had that elevated reading from where PCE was concerned again this morning. We just heard Steve talking about 6 hikes factored into the market here. And now, of course, we've got the geopolitical landscape and inflationary challenges tied to that layered on top. How do you see the Fed interpreting this, and what does it mean for policy from your standpoint in the coming months?
Well, the Fed could raise its little federal funds rate now between 0 and 0.25%. It could raise that rate 38 times and still not quite reach the rate indicated by the formerly oft-invoked Taylor rule. This is a rule created by John Taylor, the chaired professor of economics at Stanford. And Taylor's rule indicates that the Fed, to be on top of its game with respect to inflation, ought to weigh the difference between the inflation rate it sees and the inflation rate it wants on the one hand, and then weigh the growth in the economy versus the trend growth on the other. And between those factors, it can calibrate to a desirable rate. Now, Taylor says that the rate ought to be today 9.55. Not 0, not 25 basis points. So just to set the scene today, this is kind of the most extraordinary monetary setup, at least in the annals of paper money. The past year, the Fed has created, through the mysterious means of central banking, $1.3 trillion worth of new purchasing power of credit. And it has held its rate at between 0 and 0.25% in the context of an inflation now registered year over year in excess of 7%, and in the face of one of the great rip-roaring bull markets of all time. So the disparity between, on the one hand, the Fed's actions, and on the other, the provocations to greater action, almost the crying need for further action is, I think, the biggest disparity ever. It's a most remarkable scene.
So the Fed is behind the curve, very behind the curve, based on what you just
I would say that's
based on what you just said. And I think there are officials within the Fed who would actually concede that that is the case. The question is, and we were just having this debate a few minutes ago with Ed Yardeni, is this a Federal Reserve composition that has the stomach to tackle inflation as aggressively as we have seen in decades past when it's been running this hot? Yeah.
Well, the Fed is confronting 2 inflations, isn't it? It's confronting an inflation at the checkout counter, and it's confronting a much more pleasant inflation on Wall Street. I say inflation because by the lights, for example, of the cyclically adjusted PE ratio, the stock market is only less expensive than that at the peak of the dot-com bubble. People will quibble over how to measure, but certainly it's not cheap. So in the face of these 2 inflations, the Fed is invited to act. Now, the question before the House is, if the inflation in Wall Street turns into a deflation, will the Fed then have the tenacity, shall we call it, to tackle the one on Main Street? It's a very fraught question. Years and years, years ago, in the middle of the 19th century, Walter Bagehot, the great muse of central banking, said, with respect to a proposed rule governing monetary operations in the city of London, as I said years ago, he said, "Where are the rigid people to enforce the rigid rule?" And I don't see such types of human beings on our Federal Reserve Board. Today, the Fed is undertaking a so-called reverse repo operation to sop up excess liquidity on Wall Street. It's a $1.6 trillion of idle dollar bills seeking employment at 5 basis points per annum. That's another measure of how loosey-goosey things are. This is the most extraordinary juncture in monetary policy I've seen, read about, or written about. And that goes back, 200 years in my case, not all of my lifetime.